Business usually need funds for them to continue their day-to-day operation or for them to expand. So get ready to nourish your mind because for today's video, we will be talking about the sources and uses of short-term and long-term funds. At the end of this video, you should be able to distinguish debt and equity. Next, compare and contrast the loan requirements of the different banks and non-bank institutions and cite these institutions in the locality. The sources of financing are divided into two major categories, the debt financing and equity financing. In debt financing, businesses borrow money from banks or other financial or lending institutions. They also create a contractual obligation for the borrower to pay the interest and the principal. It is somehow like the contract here is the agreement of the borrower and the lender. And for the equity financing, companies issue new shares of stocks and this provides them more financial flexibility. And now, let's go on to two types of financing. So the two types of funds or the two types of financing are the long-term financing and the short-term financing. So let's have first long-term financing. Long-term financing, under this long-term financing, we have the fixed assets. When we say fixed assets, these are long-term assets that a company has purchased and is using for the production of its goods and services. So fixed assets are non-current assets, meaning the assets have a useful life of more than 1 year. With regards to the fixed assets, it includes property, plant, and equipment, and these assets are recorded on the balance sheet. And for short-term financing, under this short-term financing, they have this temporary working capital. So before we proceed to temporary working capital, let's discuss first what is a working capital. So working capital, this is also known as net working capital. So with working capital, it is the difference between a company's current assets such as cash, accounts receivable, and inventories of raw materials and the finished goods, and its current liabilities such as accounts payable. So for the temporary working capital, it is the temporary fluctuation of net working capital over and above the permanent working capital. So meaning with the temporary working capital, it is the additional working capital requirement arising out of a seasonal demand of the product or any special event which otherwise are not predictable. That is why it is called as temporary. So in other words, in temporary working capital, it is the difference between net working capital and the permanent working capital. Because in the business earnings, it is not like the salary earnings of an employee. For example, an employee earns an equal amount of money every month throughout the year, right? But in businesses are rarely of such nature. Meaning yung pag earnings ng company, it is not like the earnings of the employee which is continuous. With regards to the business, in business, businessmen get an opportunity to earn good money at a particular time and all businessmen try to grab such opportunities. So meaning, this requires the businessmen to add some working capital for them to take that advantage. Such a requirement of a working capital is a permanent or temporary working capital, I should say. So under these two naman, the long-term financing and the short-term financing, it is the permanent working capital. When we say permanent working capital, it is the minimum level of the current assets required by a firm to carry on its business operations. So meaning, no matter big or small your business is, you need to have this permanent working capital because it is a requirement for you to carry on with your business operations. Essentially, a permanent working capital, it is the minimum level of the working capital required for a firm to operate. That is why for every businesses, yun nga, mapamalaki man to or mapamaliit, they have this requirement. This is the permanent working capital. And permanent working capital is also called as the fixed working capital. So let us now have the short-term fund. So let's have first the uses of the short-term fund. So short-term funds are normally used to finance the day-to-day operations of the company. They are also used for working capital requirements such as accounts receivable and inventories. For the receivable and inventories, it measures how efficiently a company collects money from its customers and pays its suppliers for the inventory it needs to generate sales in the first place. Let's move on now to the sources of the short-term funds. So first source of short-term fund is suppliers credit. Suppliers of raw materials and merchandise are the best sources of short-term working capital. This is the good reason why good relationship has to be nurtured with the suppliers. The next source of short-term funds are advances from the stockholders. If you have enough personal assets and you control the company, meaning you possess the largest portion of stocks in the company, advancing funds from the company with our financial requirements is an easy way for the company to raise funds. Interest on these advances can be charged by the stockholders, meaning the interest on the loaned money will be depending on the stockholders' mandate. There are times na you will be creating an agreement or a contractual obligation on the payment of the interest and the principal. Third, we have credit cooperatives. Credit cooperatives can lend as much as 5 times of your equity or contributions. However, you have to be a member first of the cooperatives to be able to borrow. Chances are your company isn't. That is why if you own a company which is in need of a fund and you are at the same time a member of a credit cooperative, then you can borrow in your personal capacity from the cooperative and advance the proceeds from the loan to your company. So sometimes it is an advantageous for you if you own a company at the same time you are a member of any cooperative, because in any time that you are in need of a fund, you can go on to your cooperatives. Next to that, we also have in the sources of short-term funds, bank loans. Bank loans can provide both short-term and long-term loans. And some bank loans also offers credit facility. Let's say for example, the credit facility, it is a type of loan made in a business or corporate finance context. Kumbaga, it allows the borrowing business to take out money over an extended period of time rather than reapplying for a loan each time it needs money. So in credit facility bank loans, they are not just offering in the big corporations. They can also offer this in the small and medium businesses. Next source of short-term funds are lending companies. These are small lending companies which normally cater to small and medium enterprises or businesses. The lending process here is much faster as compared to the banks. But in here, lending companies offer or they charge higher interest than the banks. These lending companies can finance your working capital requirements. So usually, for the lending companies, that is why it is short-term funds. They can only offer this to the small businesses. So let us have this example or scenario. So Mary decided to take loan for an amount of 10,000 US dollars. So that is good for 6 months to pay. So what Mary did here is this is considered as short period loan because this is less than a year, which is 6 months. So this is treated as a short-term finance or short-term fund. So under this are the factors to be considered in choosing sources of the short-term fund. Letter A, cost. Letter B, restrictions. The third one is flexibility. And the last would be reliability. Advantage and disadvantage of having a short-term fund. So short-term financing or short-term fund as compared to long-term financing is it is easier to arrange than the long-term fund. It is also a less expensive and it provides the borrower more flexibility. With regards to disadvantage, the disadvantages of having a short-term funds are the following. The interest rates fluctuate more often than the long-term fund, and refinancing is frequently needed, and because of early maturities, the credit standing of the borrowed money may easily be adversely affected by delinquent payments. When we say delinquent payments or the payment delinquency, it is commonly used to describe a situation in which a borrower misses their due date for a single scheduled payment for a form of financing like student loans, mortgages, credit card balances, or automobile loans, as well as unsecured personal loans. So meaning if it happens that you weren't able to pay with your scheduled time, the interest is getting higher as well. Let's move on now to the uses of long-term fund. Long-term funds are used for long-term investments, or sometimes it is called as capital investments, including expansion, buying new equipment, or buying a piece of land which will be the site of future expansion. Long-term funds can also be used to finance permanent working capital requirements. And now, the sources of long-term funds. The first one is equity investors. So let's have the definition first of the equity. When we say equity, equity represents the value that would be returned to a company's shareholders if all of the assets were liquidated and all of the company's debts were paid off. So with the equity investors are people who invest money into a company in exchange for a share of ownership in the company. As far as the company is concerned, equity investors is the safest source of financing. So here, companies will issue more share of stocks that investors will buy. It is somehow like the selling of a portion of stock. So equity investors can issue common stocks through different approaches. For big companies, they can use organized stocks exchange such as the Philippine Stock Exchange. Next is internally generated fund. The company can use internally generated funds for expansion or to finance other types of capital investments. So internally generated fund, the sources of it includes profits, sale of assets and idle use assets, working capital reduction, and accounts receivable. So instead of declaring cash dividends, they can use the internally generated fund. Next are banks. As stated earlier, banks provide funds for short-term and long-term. They also provide lower interest rates as compared to other financial institutions, but they do have lots of requirements, and a borrower goes through a process, normally taking a month to 3 months before a loan gets approved. Last, we have bond market. The bond market, also debt market or credit market, it is the collective name given to all trades and issues of debt securities. It is a financial market where participants can issue new debt known as the primary market or buy and sell debt securities known as the secondary market. So governments typically use or issue bonds in order to raise capital to pay down debts or fund infrastructural improvements. In some companies, publicly traded companies issue bonds when they need to finance business expansion projects or maintain ongoing operations. So you're now at the bank loans. Bank loans, these are the amount of money loaned at interest by a bank to a borrower, usually on collateral security for a certain period of time. First bank loan, we have compensating balance. So the term compensating balance refers to the bank account balance that a customer is required to maintain upon being granted loans to ensure that the latter continues being a good customer or becomes one, and to increase the bank's interest income. So a compensating balance is a minimum bank account balance that a borrower agrees to maintain with a lender. So the purpose of this balance is to reduce the lending cost for the lender, since the lender can invest the cash located in the compensating bank account and keep some or all of the proceeds. Interest rates on consumer loans are typically quoted as the annual percentage rate or the APR. So this is the rate of return that lenders demand for the ability to borrow their money. So let's have now the prime rate of interest. So prime rate of interest, it refers to the lowest rate charged by banks to their most important and reliable business borrowers. So the prime rate or the prime interest rate is the interest rate that commercial banks charge their most creditworthy customers. It is generally large corporations. So the prime interest rate or the prime lending rate is largely determined by the federal funds rate, which is the overnight rate that banks use to lend. So let's have fixed interest rate. So this means that regardless of changes in the prime interest rate, the rate stated on a promissory note or in the contractual obligation is to be observed. So meaning a fixed interest rate is an unchanging rate charge on a liability such as loan or mortgage. It might apply during the entire term of the loan or for just part of the term, but it remains the same throughout a set period. If we have fixed interest rate, we also have floating interest rate. So as the word implies, floating. This means that the interest rate is subject to adjustment depending on the changes in the prime interest rate. So a floating interest rate is an interest rate that moves up and down with the market or an index. It can also be referred to as a variable interest rate because it can vary over the duration of the debt obligation. So fixed interest rate compared to floating interest rate, a loan can have a fixed interest rate or a floating interest rate. Let's say if the loan has a fixed interest rate, the interest rate remains constant for the duration of the loan. While if the loan has a floating interest rate, this is also called as variable interest rate, meaning the interest rate fluctuates over the duration of the loan. Next, we also have effective interest rate. So, effective interest rate, it is the rate of interest that a borrower is actually charged and is computed by dividing the amount of interest by the amount received by the borrower. So, with the effective interest rate, this is an effective annual interest rate, is the real return on a savings account or any interest-paying investment when the effects of compounding over time are taken into account. It also reveals the real percentage rate owed in interest on a loan, a credit card, or any other debt. So it is also called the effective interest rate the effective rate, or the annual equivalent rate. Let's move on now to the unsecured loans and secured loan. So as the word implies, secured and unsecured. A secured loan is one that is connected to a piece of collateral. Pag sinabi natin collateral, it is something valuable like a car or a home. With a secured loan, the lender can take possession of the collateral if the borrower don't repay the loan as you have agreed, while an unsecured loan is not protected by any collateral. So let's have first single payment note. So single payment note, this is a one-shot deal whereby the loan is granted on the assumption that the need for additional funds will not continue. So a single payment loan or note requires the entire principal plus any interest be paid at an exact date when the loan matures. So rather than paying multiple monthly payments, single payment loans assess the entire expense at one time. That is why it is called as single. Next is line of credit. This is an agreement between a commercial bank and its client to the effect that the firmer undertakes to make loanable funds available to the latter whenever the latter is in need of additional funding, provided that the total loans will not exceed the maximum amount allowed. So a line of credit is like a preset borrowing limit that can be used at any time. The borrower can access funds from the line of credit at any time as long as they do not exceed the maximum amount or the credit limit set in the agreement and meet any other requirements such as making timely minimum payments. We also have here installment loan. These required periodic payments, the borrower may refinance the loan, sometimes at lower interest rate when the principal has sufficiently decreased. So an installment loan is a fixed amount of money that you borrow and then repay in equal increments at regular intervals for a specific period of time. So on the last part of this module, the schedule of amortization. An amortization schedule is a complete table of periodic loan payments showing the amount of principal and the amount of interest that comprise each payment until the loan is paid off at the end of its term, meaning each periodic payment is the same amount in total for each period. So for the schedule of amortization, we have the long end interest and the short end interest, or for some, this is the long-term interest and short-term interest. Let's have long end interest. Long end interest is based on the balance of the principal periodic payments. So with the long-term interest, an interest rate on a financial instrument with a maturity of longer than 1 year. That is why long-term. So if it exceeds more than 1 year, this is considered as a long end interest. A long-term interest rate is usually, but not always, higher than a short-term rate because of the added risk of committing capital to a person or project for such a long period of time. While short-end interest, it is based on the installment due from the date of contract. So for the short-term interest rate, it is the rates at which short-term borrowings are affected between financial institutions or the rate at which short-term government paper is issued or traded in the market. So usually short-term interest rate, it is less than 1 year. So with regards to principal periodic payments, when we say principal, it is the money that you originally agreed to pay back. When we say interest naman, it is the cost of borrowing the principal. Generally, any payment made on an auto loan will be applied first to any fees that are due, for example, the late fees. Then, the rest of your payment will be applied to the principal balance of your loan. So that's it. That's the Module 6 for the Business Finance, ABM 004, entitled Sources and Uses of the Short-Term and the Long-Term Fund. So if you still have any queries, clarification regarding sources and uses of the short-term and long-term funds, feel free to ask your respective teachers. So thank you for listening and have a nice day ahead, everyone.
Happy learning at home with lessons made easy by Olivarian GoTeach. One proud Olivarian.